Thank you all for coming. I'm Boccaccio. I'm an analyst at Blockworks Research, and today I'm going to be the moderator for the panel Perps and Predictions. How will crypto transform TradFi derivatives with Haseeb Qureshi, Theo, and Alexia Theodorou. Before we get started, would you guys like to give an introduction of yourselves?
I'm Haseeb. I'm managing partner of Dragonfly. We're a crypto investment fund. We invest in a lot of things that are perps and prediction markets.
Very good.
Hi everyone, I'm Min, and I'm the managing partner of Theodorou Ventures. Work quite a bit with Haseeb. We're an early stage crypto investment fund. We have a global mandate focusing mostly on pre-seed and seed opportunities. And we are set up by the former investment team of Consensus.
Hi everyone, I'm Alexia. I'm looking after Kraken derivatives at Kraken.
Very good. To get us started, we had a very, very eventful Friday. How do you guys think SEXs and DEXs handled the liquidations and the events?
Not great, I think is the main answer, not great. So for those of you who are maybe peacefully sleeping, you don't own any derivatives, Friday was the largest liquidation event in crypto history. Huge amounts of capital that got liquidated on chain and off chain and on centralized exchanges. I think the standout failure probably of the day was Binance. Binance was down for almost over an hour. They had huge, massive depegs. I think you saw Atom went to like less than a cent. You saw some of their assets depeg massively. They had two LSTs, and then they had this idiosyncratic event where Athena, or USDE, which was trading pretty close to $1 on Bybit. I think Bybit went down to like 95 cents. On Curve, it was like at $1, and then on Binance, it wicked down. Had basically a flash crash on Binance at like 68 cents. So nobody could get in and out of Binance. Binance, of course, the largest venue in the world for derivatives, and so it's kind of the market. It's like 50% market share in derivatives. So that was really bad. DeFi, on the other hand, performed very well. So if you look, of course, the spot was all fine, but if you look at Hyperliquid performed fairly well. There were some API issues, but for the most part, everything was very orderly. Everything was up through the period of the market carnage. They actually liquidated huge amounts completely transparently, which is also very interesting because there's a lot of stats going around that Hyperliquid liquidated more than Binance. It's almost certainly not true, but it's just that the way they report their liquidations is reflective of reality, whereas Binance, they report only on I think it's like a second-by-second basis, meaning that if there's multiple liquidations in a single second, they only report one, which is very weird, but that's the way that it works. And then lastly, the lending facilities on chain were all beautiful. So Aave, Morpho, everything was liquidated completely without a hitch. No bad debt anywhere that you saw in like the old school V1 DeFi. So overall mixed record, but these are how you learn. Crypto kind of performs out in public, and through these stress tests, it gets better. And I think that's the same lesson this time.
Perfect. And how do you guys see SEXs versus DEXs, the competition shape up over the next year? We've seen DEXs increasingly gain market share. Do you think it continues?
Well, I think if you look at specifically for like perps, right? I think like SEXs are still at 97-98% of like the volume that we're seeing.
Well, not true anymore with Aster.
But not like that's changing very quickly, though. Yeah. Depends how you classify volume sometimes.
Yeah, volume is in the eye of the beholder.
Yeah, absolutely. And I think with Hyperliquid and all of that, that's certainly like slowly getting chipped away, which I think is really interesting. I think ultimately, the global market is a big one. If you look at sort of TradFi, I think you have like dominance that's regional. It doesn't necessarily make sense, like I think a lot of the market structures that we're used to in trading and crypto just doesn't make sense to sustain. So you're just going to get a lot of options for like, different people. And when users have more options, I think it's better for them. And as Haseeb said, like DeFi protocols are getting seasoned and people are trusting them more. And that's really cool to see because a lot of these, like, people have been working hard on them for the last 7-8 years.
And I think you would continue seeing the upward trend on the DEXs that we are seeing in the past year. It's impossible to ignore. That's where innovation happens. That's where things come in first. But on the other hand, you would keep on seeing SEXs keep on the regulation. They have the fiat on-ramp rails coming in. So I think one would complement the other without one taking over or vice versa. So I think you need both, and we would probably be seeing more of that 10% climbing up in the next year.
Yeah, I mean, if you look at the story for DeFi has been when DeFi first started. If you look back like 2018, 2019, even before DeFi summer, DeFi was mostly an experiment, and it was small dollars relative to what was happening in CeFi, and it started from a base of like basis points of what was happening in the centralized exchange space, and that number has mostly just been monotonically increasing. It obviously shot up during periods of time when there's a lot of on-chain volume, but what we're seeing now with this new generation of exchanges, if you look at things like Hyperliquid, things like Lighter, to some extent Aster, although Aster obviously has a lot of question marks around it with accusations that they're faking their volume or they're sort of, you can't actually tell what the real volume is just by looking on chain. But with a lot of these exchanges, what you're seeing is that they're getting a lot better really fast. And a lot of that, if you just look at the V1 of perpetuals on chain, right? The DYDX white paper came out in 2018. I remember the DYDX white paper. I think it was actually December of 2017 when the DYDX white paper came out. And that was the first shot at what it would look like to do derivatives on chain. And DYDX V1 was a piece of shit. It was an awful product. It was totally unusable. I mean, the same thing is very much true if you look at prediction markets, right? Prediction markets, old idea. Prediction markets are in the Ethereum white paper, which was like 2014 that was written. And it took a long time for either of these products to really work. Right, so like just DYDX white paper 2018, it really took till like 2024 for Hyperliquid to make Perps really work at a scale that was actually competitive with centralized exchanges. Same thing with prediction markets. Prediction markets, Augur was the first real prediction market. I remember I used Augur. It was horrible, an absolutely unusable product. And it really took until Polymarket, really in like 2024, to have the liquidity and the trading experience and the UX to be good enough, and the on-ramps, to be good enough to actually be a consumer product. And so I think the lesson for looking at the competition between DeFi and CeFi is that DeFi starts off looking like a toy. It starts off just completely unbearably bad. And over time, it takes a seasoning, like you put it, for it to become more liquid, more usable, to have the on-ramps better, to have the UX better, to dial in the mechanics that you need to do this in a decentralized way. But it always eventually can get to the point of being competitive. And then it has the advantage that, like, look, Hyperliquid had no downtime. Yeah. Binance was down for 2 hours. Hyperliquid, zero downtime, zero mistakes. It was programmatic because it's a blockchain. No blockchains went down on Friday. Ethereum did not go down, Solana did not go down, nothing went down. It was the centralized exchanges that ended up having the instability on Friday.
And I think it's times like this where, protocols also realize what people care about. So now there's this whole, like CeFi type execution and DeFi settlement, and that's allowed protocols to sort of reduce fees, like improve latency a lot, and ultimately, like, that just takes a lot of experimentation to sort of get all the infrastructure piece in place and figure out what people care about there. You don't need to put every single thing on chain. Mm-hmm,
mm-hmm. That's a great point. And like if you look at RFQ systems, which is becoming more and more how spot is happening on chain, these RFQ systems, we used to think, okay, well, it's DeFi if everything is on-chain and there's no off-chain component. Whereas with these RFQ systems, it's literally like a market maker that, like, has an office in London that is filling the orders, and like they're probably hedging it on Kraken or on Coinbase or whatever, Binance, whatever. And these markets are the two are blending into each other, right? You look at Hyperliquid, for example. Hyperliquid is creating USDH, their stablecoin, which is issued by Bridge, which is a centralized company, right? I mean, it's literally a fiat-backed stablecoin that's now going to be the canonical stablecoin for a decentralized exchange. Same thing with Athena. Athena has reserves sitting at custodians and has, they have positions on Binance and on OKX and whatever. So all of these things, and even with Aave, Aave has, they've got these RWA markets that you have to be KYC'd in order to use. Yep. So I think that what you're seeing also is this melding between the two, where it's not quite DeFi is here, CeFi is here. Right, even with Kraken, you guys now have an L2. Yep. Coinbase has they have the Morpho integration. All of this stuff is becoming one big market, exactly. Which is always, I think, what it was supposed to be.
Yep.
Yeah. We mentioned perpetuals and prediction markets getting better and better. One thing that hasn't gotten much better is options. Yep. We're still not using options a lot in crypto, I think, both on the DEXs and the SEXs. Why do you guys think that is?
Yeah, it's an interesting question. We keep also debating in Kraken as well. I think if we take a step back to see what's the expectation here, there is a lot of expectation when we look into traditional finance markets. So in traditional finance markets, you see options taking up multiples of volumes when it comes to derivatives. They are a lot more interesting products to trade. You can trade on volatility, on speculation. So you can do a lot more things that you can do with futures, which is just a Delta One product. But we don't see this in crypto. In crypto, it's roughly 3% of the derivative space, so it really doesn't trade as much. So why is that? There are many theories, right? I think the one I mostly believe in is that perps are so much better. There isn't a perps product in traditional finance that does that for the retail client. So perps are simple. You capture the speculative angle of derivatives, and it's very easy to trade it in and out, no expirations, and much more predictable funding rates coming in. So I think that's a main use case that it's been taken out of options. And because we have also not seen anyone nailing down the user experience as well for the retail client. So you log into exchanges and you see they're built for makers, not for takers. So then that takes out that flow element which institutional clients need, and it's back to that chicken and egg situation, no flow, no institutional demand either. And I think one more point here is that the flow of options is too concentrated on a few exchanges which are offshore, and that also doesn't bring in that institutional demand. So once we see more regulated exchanges bringing in or taking off for options, then you probably see more institutional demand coming in.
Perfect. One thing you mentioned there is that perpetuals are what we really like in crypto. One question I've been thinking about is tokenization versus perpification. Like, instead of bringing some of these real-world assets on chain, wouldn't it make more sense to just launch perpetuals markets for this? Do you guys think this makes sense, or do you think that perpification is stupid and we should just focus on tokenization?
So, if you think about, say, tokenizing equity, at least on day one, like in my opinion, you have a worse product because you have worse liquidity and it's tougher to trade. Like, you will have other benefits from that tokenization. You can use it as, collateral for getting a loan where it might be more difficult, and you can cross margin into crypto, all of that. I'm not sure how big that market is. Whereas I think when you say do an equity perp, it's just such an elegant expression of leverage, and also, with the continuous sort of price function, you can use that for hedging in such better ways. I think related to the question of options, like I actually think if you look at like Robinhood, why there was such an explosion of options, and people look at that with crypto, why isn't that happening? I'm like, well, I think it's because like there's no equity perps yet. Yeah. It's just by far a better product. I think it's one of the best inventions of crypto, and there's certainly some challenges with stuff like equity perpetuals that are leading people to focus on tokenization first. Like, there's, for a lot of equities, you have a lot of discrete price jumps. So you have to figure out how to deal with like stuff like corporate actions, like dividends and whatnot. You don't really have that in crypto right now. But I do think with a lot of experimentation, you'll be able to solve that. There was a lot of regulation was preventing that experimentation. And now I think that those hurdles have been alleviated somewhat. And then there are a lot of great minds in crypto trying to look at that. One example I can that kind of gives me hope that I think equity perps and the challenges of it can be solved quite quickly is we've somehow figured out, how to do perps for pre-launch like tokens, and they're working decently well, right? And that is a pretty big problem with like not having an oracle for that. And I think there's demand, volumes are still relatively small, but I think it'll grow quickly. And I think we'll probably see equity perps develop quite a lot in the next few years.
I think that's definitely going to develop much faster. It's much easier to see perpification of traditional assets because it's so much easier to list. But then it goes down also to the initial point of how reliable is that oracle to make sure that you keep on valuing and keep on managing that risk in a reliable way. When things like the Friday event happens, you don't hit that. So there is a balance to be struck on both. But yeah, I agree.
Yeah, I think it's also worth elaborating, like, why would you not want a perp? Mm-hmm. So one, I do think market structure is path dependent. I don't think there's like one optimal market structure that everybody is going to evolve towards. If you look at, so this weekend, we saw one of the largest auto deleveraging events. It's often abbreviated ADL. And automatic deleveraging is basically when the market is moving so aggressively in a perp, because a perp is it's basically you put money in a pot and two people are betting. I'm betting one way, you're betting the other way, and whoever wins gets the money in the pot. But sometimes the P&L is so big that the money in the pot cannot cover it. And when that happens, what happens is what's called auto deleveraging, which is that there's just not enough money to go around, and we're not going to be able to liquidate anybody efficiently. So we just basically have to kick people out of the bet and say, sorry, you're out. You're no longer in this market. And that happened. It's a very, very rare event, but it happened across almost every single exchange that does perps on Friday. Now, that kind of thing doesn't happen with futures, right? Futures don't work that way. And with, if you think about some of the largest markets in the world, whether on, interest rates or, commodities, they're mostly dated futures, right? And there's some dated futures as well, like OKX, I think, has a very large dated futures market in crypto. But they're relatively small, in large part because in crypto, people don't worry so much about the downside. They care a lot more about the upside, right? And that's not true for a lot of these instruments because in traditional finance, the reason why these instruments arose was not speculation. The reason why these instruments arose was hedging and risk management, right? It's basically the allocation of risk to people who are better able to absorb that risk. In crypto, there are not many natural hedgers of risk, right? There are people who maybe are moving risk around because they're a market maker and they need a hedge over here, over there. But there's not people who are like, my business is exposed to, lumber costs, and so I'm going to go hedge lumber, right? There's nobody who has that in crypto except maybe miners. That's kind of the only real natural hedgers that we have in crypto. And unfortunately, miners are becoming smaller and smaller as a portion of the total supply because Bitcoin is halving. And of course, Ethereum doesn't have mining. So there really is not that equivalent in the crypto market. And so if you look at Robinhood, Robinhood obviously has enormous options volume, kind of as a regulatory arbitrage, right? Like, why can't they just go, trade on crazy margin and just get blown out when they trade on, crazy margin ratios? The answer is regulation, because Robinhood's like, we don't trust you to do that. That's insane. Of course, you can't do that. But you can buy options because you filled in some form that said you're a smart guy and you can trade this on Robinhood, which like every DGen on Wall Street Bets is doing. And so this is mostly, I think, a regulatory arb, is that options are a weird product. They're very difficult to reason about. Most retail doesn't have any idea what they're doing other than that they know that they're taking on enormous leverage when they buy a very short-dated, out-of-the-money option. I think crypto has largely solved that problem for speculators, is that it's a better product for speculators. But it's not obvious to me that a perp is a better product for somebody who's just naturally hedging, because you can end up paying like this huge basis. You don't necessarily know over time what you're paying when you're going into a market. Whereas with the future, the moment you get into the market, you know what you're paying if you're holding it to expiry. So that's a big difference between those two market structures that I think sometimes goes underappreciated. Is that if you were starting over again, looking at the corn market, I don't know that you look at the corn market and say, well, clearly they should do perps, and we should move corn over into perps. I think these markets are very different because they're composed of very different kinds of players and different kinds of flows.
I agree. I think it's the fact that crypto doesn't have a lot of, it's mostly speculation right now. So the moment you take hedging out of the picture, which doesn't exist, then you lose a big use case of traditional finance market, right? So that's where we probably see that thesis evolving differently.
That makes sense. Last up on perps, we've seen some new perpetuals platforms offer zero maker and taker fees. In traditional exchanges, we've seen them kind of catch on as well. Do you guys see within crypto all DEXs and SEXs to start offering zero maker taker fees, or do you guys think it'll just be isolated perpetuals platforms?
Well, so I assume you're referring to Lighter.
Yes.
So we're investors in Lighter, I should caveat. So Binance for a while had zero fees on BTC. And actually, a lot of exchanges have had periods of time where they had zero fees, particularly on spot. Most exchanges that do spot and derivatives is the moneymaker. They make way more money on derivatives than they make on spot. So spot is often a loss leader or just a way to get people in the door for the real competition, which is on derivatives. So having zero fees is not atypical for exchanges, especially that are getting off the ground. Lighter is very, very early. It's pre-token and pre-TGE. Now, that being said, Lighter, it's worth noting, when they were in private beta, they had zero fees for everybody. Now they open to public beta, it's zero fees for retail or for normal traders, quick traders. But if you want API access, which is more for like market makers and institutions, there are fees. So I think where Lighter is evolving to is more similar to like Robinhood. So Robinhood has they have zero fees, obviously for retail, zero commission trading, and which is now more and more of the consumer brokerages were pushed by Robinhood to go toward the zero commission trading model. But they make their money by basically auctioning off their flow, which is juicy retail flow, to market makers. And this is called payment for order flow, PFOF, which there was a lot of hullabaloo about it when there was the whole GameStop saga. So I think where Lighter is moving is probably more in that direction, which is that this retail perps flow is attractive flow. Market makers want to serve it. And so you can charge the market makers who are serving that flow, who need API access and are trading not by clicking buttons on an interface, but by using APIs programmatically. You can charge them and basically price discriminate, which is really where you want to be living at the end of the day, is charge the smart money and bring the uninformed flow in and allow them to trade as attractively as possible.
Perfect. For prediction markets.
Hold on. I'm curious what Kraken has to say about that.
Yes, I mean, I don't know, I kind of disagree with you on one part in the sense that the retail client that comes in, they're not as fee sensitive, right? So a client that comes in to trade perps or any other market for that matter, they're not as fee sensitive as a market maker or an institutional client that tries to cross margin or tries to do portfolio margining either within an exchange or outside of the exchange. So seeing zero fees on both taker and maker side, I think it just creates a bit of a disorderly market in the sense that there's no revenue generated, and that brings in more deals with the big market makers just to cover on the fact that you don't get your fees and rebates out of the retail flow that's coming in your books. So I think there is a balance to be had there. Yes, you can use it as a promotional tool for sure to bring in your clients, but if you want to run a central limit order book, I think you need to have that balance, especially with rebates being given out to market makers in crypto, to bring in the flow and reward the people who make the markets in your order books a bit differently.
Well, so I think So what fundamentally is the difference between PFOF, payment for order flow, and just traditional charging fees in an exchange? The answer is transactional pricing versus value-based pricing. When you're just charging fees on makers and takers, right? Then basically it's just whatever the market will bear with respect to fees for everybody. Everybody pays the same fees, no matter how smart you are and how dumb you are, et cetera. Or obviously, there's you get discounts when you're a market maker, or rebates, or if you're a big trader, you trade more, you get lower fees, et cetera. But ignore all that. Let's pretend everyone's paying the same fee. With PFOF, with payment for order flow, what's happening is that the market makers, of course, are making a lot of money because they're trading against people who are not very good at trading. And really, what you want more than just I want a flat fee from everyone. I want some of the profits that the market makers are making. Right? And if you're just charging a flat fee on every transaction, you can't really reach into the profits they're making. Right? If you look at Jump, or even bigger than Jump, Jane Street. Right? Yeah. Jane Street had, I think, the most legendary quarter in trading history. What was it? They made like 10 billion or something. Some crazy amount of money they're making, mostly, I guess, in India on retail trading options. Right? If you're just charging the Indian stock exchange or whatever is charging, some basis points on every trade, they're making almost nothing compared to what Jane Street's making. But if you auction off the flow, and Jane Street is bidding in that auction to say, I want to trade against this, this Indian retail, and they're just doing random stuff, they're just punting into crazy, out of the money options, then as an exchange, you can capture a lot more of the profit that's being generated on your platform through value-based pricing instead of transaction-based pricing. That's why I think payment for order flow is more attractive to exchanges in the limit if you have a lot of uninformed flow on your platform.
Yes.
Now, there's ways you can do it badly, but I do think that's why Robinhood has moved in that direction, and why I think more and more exchanges over time are going to move in that direction.
Fair. Yes, I agree on that.
Perfect. Prediction markets still have relatively low volume compared to perpetuals products. Where do you guys see the next level of volume for prediction markets coming from? Is it sports books? Is it anything else?
I mean, I think yes, they do have low volumes for sure. But again, if we look at where prediction markets were last year, we see tremendous growth in the last year, right? So Kalshi, I think, estimating 50 billion annualized volumes, which was a lot, which is a huge growth from where they were last year. So it's definitely not something to ignore, and that's, I would say, I don't think there is any other asset class that appeals to more use cases than prediction markets. You can appeal from I don't know, a Taylor Swift enthusiasm to a macroeconomist, right? So there is definitely a lot to be had in prediction markets, and it's something that we would keep on seeing growing, both in the US, which is currently where it's predominantly based, but also globally. Again, we've seen ICE and Polymarket partnering up, signaling a strong institutional demand coming in there, and also Kalshi announcing global expansion in more than 100 countries. So that's definitely something that we would be seeing. But yeah, curious to hear from you as well.
Well, so we're investors in Polymarket, so I obviously have known the team for a very long time. I think the one obvious answer is sports betting. So if you look at Kalshi went from relatively low base of sports betting to now over 80% of their trading volume is in sports. You can see now there's a Polymarket app floating around that's going to be like largely driven by sports betting because that's where a lot of retail engages. The thing to understand about prediction markets is that prediction markets are very analogous to something like Airbnb, where Airbnb is, I used to work at Airbnb. Airbnb is a weird company because it was basically a company that created a new consumer behavior. People did not stay in each other's houses before Airbnb, right? You stayed in your friends' houses maybe, but you did not pay a stranger to stay in their house. So it created a new kind of consumer behavior and a new wellspring of demand where none existed before, right? In the same way, there was nothing that Polymarket was competing with to get people to bet on whether or not Taylor Swift was going to get engaged, right? That's a new consumer behavior. And whenever you have a business that is predicated on creating a new consumer behavior, it's an uphill battle in the beginning, but when it grows like crazy. And that's kind of what you saw with Polymarket, is that like Polymarket was around in the 2020 election. Yeah. But the numbers were way smaller. Now that before 2024, almost every time the Polymarket had any meaningful numbers, it was either the election or the World Cup. Besides that, it was basically a ghost town, almost nothing happening. Volumes were tiny, tiny, tiny compared to the kind of numbers that we see today. Only after the 2024 election has the trading volume and the engagement on Polymarket been basically consistent in terms of the number of traders and the amount of engagement that you're seeing, which looks very much like what happened to something like Airbnb, which is that before it's like nothing, 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 boom, now this behavior is normalized. And once the behavior is normalized, it just starts spreading through society. And I think that's what we're going to start seeing with Polymarket. With the integration into ICE, you see it now with Kalshi and sports betting with Robinhood, is that these distribution partners and the distribution channels, I think it was just yesterday that some footballer was talking about Polymarket that went super viral. You guys know what I'm talking about? Somebody probably knows what I'm talking about. Somebody mentioned, oh, check the Polymarket yesterday in like some big interview, and it went super viral. So like that, the way in which it's seeping into popular culture, that's like a one-way ratchet. That's only going to continue over time as prediction markets just become normalized in everyday life.
Yeah, so I think it's the breadth of instruments, right, where you're going to be attracting the interest from, but also in distribution. So now I think we only see two brokers offering it, Webull and Robinhood, but I think the more brokers are out there that will be offering, then you increase your distribution channels whilst you increase the breadth of the offering, and then that's how it exponentially probably will grow in the future.
Yeah. The other thing too is that a lot of Polymarket right now is built off of retail trading. And so, sports betting obviously is a retail thing. And then even, the markets that you see today, many of them like, Taylor Swift or, this or that, who's gonna, is President Trump going to say this word in the speech? These are obviously retail type markets. But some of the biggest markets on Polymarket are really about macroeconomic events, right? So one of the most important markets right now is about the government shutdown, which is when is the government shutdown going to end? And a lot of Wall Street analysts are looking at the Polymarket on when is the government shutdown going to end as an input into their models to price equities, to price commodities, everything. These big markets really, really matter for that kind of stuff. So I think what you will see through the brokers is Wall Street coming in and starting to participate on these markets, again, not just to bet on them themselves, but to hedge their risk. Mm-hmm. And that's where a lot of these markets are going to get really, really big. Bigger. Right? These macroeconomic markets and geopolitical markets is where I think you're going to see the Wall Street engagement be the highest.
And I think if you look at, this is something that Wall Street's been doing for a long time. Like if you look at Fed funds futures, like people are making bets on Fed decisions at the end of the day. And Wall Street would love more of these markets. They've actually tried to create these markets in the last 10, 15 years after the GFC. I think there was a time where they were trying to create a market on the jobs report. And the problem is a lot of these markets, you know, in the context of TradFi, are really expensive to bootstrap. And you have a chicken or egg problem because if it's expensive to do, if there's no activity, there's no traders, no one wants to trade there. Whereas I think what the interesting thing that, you know, we've come up with this new primitive is you can actually, you know, bootstrap new markets. You can probably use AI and LLMs to also like, you know, help with that further. So there's going to be a lot of like interesting macro indicators that people can bet on and like, you know, will reference as we saw in the election. And it's also really cool, I think, new social behavior as we see in South Park, right? So I think that's something that's really going to grow. Like, and we probably shouldn't compare it to financial markets per se, because like prediction markets to me, it's like, you know, it's an expression of a bet, and then you're trying to financialize something that's actually not financial. Like, I don't think you're going to see someone do like, you know, like $100 million level like bet on a Chelsea and Arsenal match like anytime soon, like they do on Bitcoin like every single day. So it's just fundamentally different things, and like, you know, I think it's gonna grow exponentially in the years come.
And how do you guys see regulation play out for prediction markets over the next few years?
I think that's what's going to be key on the growth of prediction markets, because if you see what happened with Perps, for example, it took a lot of time for regulators to understand them, to regulate them, and to establish a strong regime around them. And only when you see strong regime, then you kind of see the institutional adoption coming in. So how would Kalshi and Polymarket bring those prediction markets into more regulated markets? Would it be an event regulated as a derivative? Would it be a sport bet regulated as under gambling regulations? I think that's where we would probably see the big debate with regulators and these key players trying to influence the regulation around them. And depending where that lands, then you would see those distribution channels growing on the areas where you see more demand coming in. But at the moment, I believe that the events and derivatives kind of fit those better, with the sports books coming in and adapting them more than the other way around.
Well, I'm certainly not a regulation expert, so I wouldn't presume to know. But you know, at least in the U.S., we are now effectively a government run by crypto bros. So that puts us in a weird situation that probably, at least for the next 3 years, it's, you know, all systems go for prediction markets. Kalshi and Polymarket have both made friends in high places. Now, that being said, the sports betting lobby is very upset about Kalshi in particular, because Kalshi has now got these, you know, they got these sports contracts that they're offering to Americans, and they claim that this is not cool. You can't do this. This is, you know, we went and got these state-by-state licenses, and you're doing this under some, you know, national license as a CFTC-regulated exchange. And I don't know where that's going, but it does seem like, for whatever reason now, the crypto lobby in the U.S. is like the strongest lobby, seemingly. It's like stronger than the banks somehow. So like the banks are really upset about the Genius Act, and everybody's like, shut up, you know, it's already, it's over, you lost. So I don't really know where this is going, but it does seem like the prediction markets, they have a lot of allies, and there's a lot of belief that, look, maybe the sports betting guys are going to be upset that prediction markets are now, you know, basically coming in and eating their lunch. But at the end of the day, the innovation and the positive externalities of prediction markets are so strong and so obvious to people, right? It's like some of these things, it's kind of torture to explain why this is important to have. For prediction markets, everybody gets it.
Yes.
After this last election, everybody gets why these are valuable and why you want them to exist and to get out of their way.
But that's exactly why regulators cannot ignore them, right? So you cannot live under the radar and just offer them to clients without having a specific regime to offer them. So I think that's why regulators would probably try to understand them a bit more and regulate them. But where you want to land, if you are one of those markets, is you want a global liquidity pool, right? You don't want to see fragmentation happening differently in Europe, differently in US, and differently in other sides of the world, because that's where this breaks. You want to have global liquidity where the market makers and all the institutional clients come in and offer it unified across the world. So hopefully there's going to be some consensus around it.
Yeah, I mean, I think de facto that is not where we're going. So right now it looks like, you know, so Polymarket, they have their global, you know, sort of on-chain product that's on Polygon. Kalshi only has this regulated US-facing product. But Kalshi is, you know, sort of an open secret now that Kalshi is going to be launching a crypto-native product, and Polymarket, of course, getting CFTC licensed. And obviously, the on-chain product has global users, which you're not. It's not KYC to AML. So to the extent that that product is going to continue existing, that's going to be the offshore product. Then there's going to be the onshore product, and vice versa for Kalshi. So my guess is that that's where we're going. Is that there's going to be this global unified liquidity that you can trade on chain, and there's going to be this onshore that brokers and all these people and Wall Street is going to be directly plugged into.
Offer the flows on.
Yeah, exactly. And there may be some hedging between the two that keeps prices in line for markets that are interesting to both. But it seems like international and U.S. onshore are probably going to be two separate magisteria.
Which is similar to what we are seeing with Perps, right? You see the on-chain happening regardless of what's happening around the regulation, but then you see Europe dictating onshore venues for you to run your Perps, and US also trying to understand how to access those global liquidity pools that you have in Europe and rest of the world to offer them in the US without breaking and fragmenting your liquidity. So yes, for sure.
Yeah.
I think that's...
But like if you look at, if you look in... for DeFi, one can make the argument, going back to Perps, that the existence of something like Hyperliquid, where anybody in the world with a mobile phone can decide, I'm trading Perps today, that makes it very difficult for regulation writ large to really have that much of an effect.
To clamp down.
Where if you're trying to do investor protection type regulation and say, hey, I don't want you taking on too much leverage because that's just socially harmful. Well, some guy in, wherever, a very regulated venue in France or whatever it is, can just say, I don't care. I'm going to go on Hyperliquid, and I'm going to lever up 50x and just get liquidated in 5 seconds. And now for Polymarket, I think that argument is less true because of the fact that the kind of liquidity and the kind of traders that are available in the Polygon on-chain market are so materially different than the kind of traders and the kind of liquidity that's going to be available if you plug into NYSE. That's just a totally different universe. And the kind of products that are going to get traded at the scale that they're going to get traded are just totally different. Now, that being said, again, as long as there's a unified market, or as long as there's a market, there's somebody who can unify that market, right? If there's liquidity on the regulated on-chain, or sorry, the regulated off-chain Polymarket venue, then somebody, at least one person, can basically play arbitrage between the two and match the liquidity from one venue to the other. And so I do think what you will see, even if only the onshore venue has all these big, kind of traditional players doing real size and providing real liquidity there, that will get matched onto the on-chain venue. The same way that RFQ systems that exist in DeFi Spot, they play this bridge where even if the liquidity is not there, that person, even if they're, let's say, a firm here in London, they can play the middleman and give you Binance-level liquidity on-chain just by basically playing a go-between. And so I think you'll see the same thing happen with prediction markets. On-chain will become massively more liquid because of the off-chain liquidity.
Perfect. We have just under 2 minutes. I want to ask each of you for a prediction or a hot take for either prediction markets or perpetuals. I'll let you guys decide on who wants to go first. Or I can pick if you really want me.
You should pick.
Yeah.
Alexia, let's go.
I can start. So yeah, I think prediction markets, as I said, we would be seeing a lot more happening in prediction markets in the next year. Already they're making a lot of noise. Already they're making friends in high places. So I think that's definitely an area where we should be looking out, especially as more distribution channels get unlocked in the various sides of the world. So for sure, a big growth trend coming in there. Perps, I think, are already well established. We have been working very closely with regulators globally to ensure that there is less fragmentation when it comes to regulating Perps. So I'm very bullish on that adoption that will come from institutional clients, especially on onshore venues as well. Bigger and more regulated institutional clients will be coming in, which would bring that flow that we would see with options and structured products start to getting off in the sense that we've been looking for. So that's my take.
Yeah. I think in terms of Perps, I would say like equity Perps could eclipse the retail, equity options market in the next 3 years, is my prediction. And maybe on prediction markets, I think, we talk a lot about regulation. I actually think one of the bigger challenges is getting an app through the App Store for broad distribution if you really want to go through those mainstream sports betting, sort of use cases. So we'd love to see it. I think that's how you really build a brand, and Polymarkets has built a strong brand there.
Boy, I don't know that I have any hot takes. I think I kind of exhausted them already, but My main thing is I'm pretty bullish on both. I think probably not that much is going to change. You're just going to see both of those grow. They're just going to keep going up.
Perfect. Fantastic. Guys, thank you so much for participating in this panel. This was fantastic.
Thank you so much.
Thanks, everybody.